India, as a rapidly developing nation, is on a path to diversify its energy sources and reduce its dependence on fossil fuels. In this pursuit, ethanol has emerged as a game changer, presenting a tremendous market opportunity. This avenue of investment not only offers just financial growth, but also an avenue to contribute to a greener future. Now, the ethanol market in India has witnessed remarkable growth in recent years, driven by supportive government policies and increased environmental consciousness. Now, ethanol investments have shot up with large manufacturing capacity additions coming in. However, ethanol-oriented stocks have turned bittersweet recently on the back of new government curbs. In this episode, let's talk ethanol. We will talk about the massive opportunity ethanol presents. We will also talk about the government's blending program and the progress so far. We will talk about the impact of government curbs on the sector, and then we will discuss the factors that you need to consider before investing in this opportunity. Let's begin. You're watching Informed Investor and initiated by Research and Ranking. India ranks as the world's third largest energy consumer, and a big chunk of our energy needs is fulfilled through oil, which we primarily import. Just to give you a snapshot, more than 80% of India's oil requirements are imported, and a massive 26% of the country's import bill goes into this. Now, because oil is dollar-linked, this triggers massive foreign currency outflows and the depreciation of the rupee. And of course, there's the environmental concern. The excessive use of fossil fuels, as we all know, translates to higher carbon emissions. Now, while we do have electric vehicles on the scene, it's going to take a bit more time before they can fully replace traditional vehicles. So what's the government's game plan now? India has been laser focused on ethanol production. The government has mandated the blending of ethanol with petrol to cut down on emissions and promote cleaner fuels. They've rolled out a series of policies, and one standout initiative is the ethanol blending program. Now, under this program, the government is aiming for a 20% blending of ethanol with petrol by the year 2025. Now, to sweeten the deal and incentivize higher ethanol production, the government has also come up with some attractive offerings. There's a price hike for ethanol procurement, and they've also slashed the GST rate on ethanol used for blending from 18% to a mere 5%. Now, the government thinks the ethanol blending with petrol program is great for a few reasons. By blending ethanol with petrol, we're looking to save a ton of money that we won't have to spend on importing fossil fuels, ultimately reducing our dependence on other countries for fuel. And according to government data, under the ethanol blending program, it has resulted in savings of more than Rs 24,300 crore of foreign exchange in ESY 2023. Then there's the environmental angle. The mix of 20% ethanol and 80% petrol is expected to significantly cut down on harmful emissions. We're talking about a 20% drop in hydrocarbon effluents and a substantial 30% to 50% reduction in carbon monoxide. The government is also spotlighting the positive impact on our farmers. By providing an additional income source and creating employment opportunities for farmers, it becomes a player in rural development. Under the program, according to the government data, payment of about Rs 19,300 crore has also been made to farmers. Now, considering all these factors, the ethanol sector is expanding. With the potential to save billions of dollars in oil imports and simultaneously protecting the environment, ethanol is being hailed as the next superfuel. Now, let's talk about the progress of India's ethanol blending program. Back in 2003, when India first introduced the ethanol program with the aim of blending it with petrol, things didn't quite take off as expected. From 2003 to 2014, the average blending with petrol hovered at a modest 0.1 to 1.5%. Now, fast forward to today, and we've seen a remarkable surge in ethanol's prominence in our energy mix, with the current blending rate standing at an impressive 12%. The progress led the government to also revise its goals, advancing the target year for achieving 20% ethanol blending from 2030 to the more ambitious 2025. Now, before we deep dive into the specifics of the ethanol sector and the beneficiaries of this opportunity, let's get a grasp of how ethanol is made. Ethanol, a renewable fuel, is primarily derived from sugarcane, and India is one of the largest global producers of this crop. Traditionally, businesses engaged in sugar production would extract the juice from sugarcane, discarding the leftover cane. However, with advancements in technology, this sugarcane waste, known as sugarcane molasses, is repurposed in distilleries to create ethanol. In some instances, other raw materials such as grains like maize or biomass sources like agricultural residues may also be used in the ethanol production process. Now, this key role in the production of ethanol is often played by industries involved in sugar manufacturing. The ethanol produced is then acquired by oil marketing firms from the sugar producers, and the next step, these oil marketing firms mix ethanol with petrol. Now let's talk about the demand and opportunities in the ethanol sector. According to projections, the demand for ethanol blending, which stood at about 38 crore litres in 2014, is anticipated to witness a threefold increase, reaching 1,016 crore litres by 2026. Now the surge in demand translates into significant capacity expansion by ethanol manufacturers, presenting a tremendous opportunity for sugar companies. Take Balrampur Chini, a sugar company, for example. The company recently ramped up its ethanol production by an impressive 50%, reaching nearly 30 crore litres. Now, the growth in its distillery business has also become a noteworthy contributor, constituting 33% of the company's total revenue compared to 19.62% in quarter two fiscal year 23. Now, EID Parry, another player in the sugar industry, is investing 268 crore rupees in fiscal year 24 to enhance its ethanol production capacity. There are also other players such as Sri Renuka Sugars, which sees its ethanol business contribute about 40% of its revenues. Now, in contrast to other companies, Praj Industries specializes in supplying technology for ethanol production rather than being a sugar producer. The September ended quarter of fiscal year 24, the company generated a substantial 79% of its income from the bioenergy segment. Now we see how ethanol blending program has helped sugar companies diversify from its core business. On the back of this ample opportunity and the government blending program, ethanol-oriented stocks have been soaring. Now let's discuss the latest directive that has added a bittersweet twist to the narrative. The government has thrown a curveball by announcing a ban on the usage of sugarcane juice and sugar syrup for ethanol production during the supply year fiscal year 24. Now, to understand this better, let's revisit the three main routes for producing ethanol from sugarcane. Now, the C-heavy route involves processing ethanol from molasses that can no longer be used for sugar crystallization. Initially, this was the only exclusive method allowed for ethanol production. Now, to amp up the ethanol supply, the policy then gave the green light for producing ethanol from both B-heavy and cane juice modes. Now, this meant sugar mills could now produce ethanol directly from crushed sugarcane instead of going through the sugar production process. When it comes to yields, converting entire cane juice to ethanol from 1 ton of cane gives us about 80 to 81 liters of high-grade ethanol. That's way more than 21 liters of medium-grade and 10 liters of low-grade ethanol we get through B-heavy and C-heavy molasses routes, respectively. Now, we see ethanol is produced from diverse sources, with B-heavy molasses contributing about 48%, juice accounting for 27%, rice providing 15%, maize contributing 4%, and the remaining 5% sourced from damaged food grains. Now, the government has put brakes on using sugarcane juice and sugar syrup for ethanol production, but the supply of ethanol from B-heavy molasses, C-heavy molasses, and the grains will still continue. The change in regulations was prompted by concerns about a potential shortage of sugar. Key sugarcane producing states like Maharashtra and Karnataka were expected to face a decline in sugarcane and sugar production due to inadequate rainfall. So the government's move is aimed to prevent a shortage of sugar and notably to keep sugar prices from soaring, especially in the lead up to the 2024 general elections. Now, this change had a tangible impact on ethanol-oriented stocks, and in the past week, shares of sugar companies and other ethanol-focused firms experienced a downward trend. Now, coming to the impact on the industry. According to CRISIL, the projected sugar output, initially anticipated to decline by about 10 to 11%, is now expected to contract at a slow pace of 3 to 4% due to the imposed restrictions. Now, this shift in production dynamics is likely to influence sugar prices significantly, with an increase in supply expected to result in low prices. Additionally, there is this potential for a decrease in ethanol volumes, especially for companies focused on cane juice ethanol production. Ethanol, being a high-margin business for sugar companies, may face challenges in maintaining profitability with a decline in volumes. However, the overall impact varies on the types of businesses within the sugar industry based on what feedstocks a particular sugar company utilizes to make ethanol. It's crucial to note that the ban is temporary and primarily aimed at curbing sugar prices in the short term. If domestic sugar inventories improve beyond current expectation, the decision might be reversed. The government also reiterated its commitment to achieving the 20% ethanol blending target by 2025, emphasizing that the temporary ban is a precautionary measure due to the uncertainties in cane output for the current season. It's also worth noting that India's ethanol program is no longer reliant on a single feedstock or crop. Previously centered around molasses and cane, it now includes rice, maize, and other grains. Now, this diversification of feedstock is expected to minimize supply fluctuations and price volatility. Now, the government's firm commitment to achieving a 20% ethanol blending target by 2025 to 2026 is a clear signal of their long-term dedication to renewable and clean energy. Now, this opens up potential investment opportunities for those looking at companies. But here are some factors to consider before investing in ethanol stocks. Government policies, as seen in the recent ban on sugarcane juice and sugar syrup for ethanol production, can have a significant impact on the ethanol industries. investors should closely monitor government decisions, especially those related to feedstocks and production methods. Now, for companies in the sugar sector, the cultivation of sugar is highly dependent on water availability, especially during the monsoon season. Investors should be mindful of how variation in monsoon patterns might impact the overall performance of these companies. In addition, the government's policy on exports and the movement in international prices also has a direct impact on the earnings profile of sugar companies. So even if the company is benefiting from its ethanol production division, the impact on the main business of sugar manufacturers could potentially weigh on ethanol stock prices. Now, ethanol being a commodity tends to perform well in inflationary environments. Understanding economic conditions and how they might impact commodity prices can also be crucial for investors seeking to add ethanol stocks to their portfolios. Having said that, this is me, Merlin Sana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.